Alright then guys, welcome back to AG Online. This afternoon we're just going to make sure that everyone's up to the same sort of level on futures and options. So there will be some reasonably basic stuff. There'll also hopefully be something that you've not always thought of, or something that's particularly more related to actual trading than the specifics of what a futures contract is, etc. You know, I'm not going to go into major amounts of detail. Have any of you traded options or had any experience with options? No? Okay, cool. We're not going to go into, again, sort of extreme detail of options strategies. We'll go into a couple of basic ideas, but really it's more about how strategies that are operated in options can then create a movement in futures, or how people use futures to enhance or hedge their option strategies, and that creates a bit of flow in futures markets, which then is tradable opportunities. So we'll move first on with futures contracts. Everyone know what a futures contract is, hopefully, since you've all traded them before. Basically it's derivative of an underlying asset. Whenever you hear anyone talk about cash market, that is the underlying market. So cash S&Ps, cash DAX, etc. You do need to, or it is very useful to know the opening and closing times of the cash, because futures in every situation always trade longer hours than the cash. So knowing when the cash market shuts is a bit of a help. You'll notice volume drops off very, very quickly as soon as cash shuts. You see this across the board in everything. And then what will generally happen is European futures will start to track US futures for the afternoon session once that's happened. The only market that doesn't really have a cash open close is foreign exchange, and that has periods of busyness, but foreign exchange trades all day, and it doesn't have a centralized market, so that doesn't have a specific cash in terms of hours, but it does have a cash relative. And generally for non-day traders, for banks, etc., they're always looking for something in relation to the cash. So there's generally some kind of spread between the two of owning the cash and trading the futures, or the other way around. Effectively trying to limit your risk, not something that you would do from an individual's perspective. Reason being, to hedge in the cash market, you've then got to have the value of the futures to hedge in the cash market. And you take, for example, if you're trading one lot in the FTSE, that has a notional value of 100 grand. To hedge it in the cash market, you've then got to go and buy £100,000 worth of FTSE stocks, which in terms of your cost of your transaction cost is then going to make it prohibitive to really trade one against the other. Standardized, so they provide specific delivery date, specified quantity, quality, and for a certain price. So that price comes from whatever price you execute it at, and then come the delivery point, you will get whatever you have bought at that price, not at whatever it closes at. They do vary in terms of how long the contracts are. Generally, the more sort of equity, bond, currency contracts are all for 3 months. So you get a 3-month contract there. Commodity contracts are generally monthly. There are now foreign exchange ones that are monthly as well. However, the middle months barely trade at all. So when you get your sims up, you'll see that, say if you pick a euro future, euro currency future, there will be an option to have January, February, March, April, May, etc. March and June will trade, September will trade, December will trade. The others barely trade at all. Why they've started to do this, I'm not sure. I think it provides people an opportunity to hedge between months, but the fact that there's nothing there to trade is going to make that hedging very difficult. Right, that's the key thing as well, that they're standardised and they're on an exchange. If they're not on an exchange, they're forwards. These are negotiated individually between banks, between individuals, between whoever. You can arrange a forward contract for however much money you want, for whatever time frame you want, and it is entirely off exchange, which does mean that selling that contract then becomes quite difficult, because you've now got to find someone who wants the specific criteria that you had. Whereas with futures, there's a greater deal of liquidity, everyone knows what they're getting, it's all very standardized, obviously, and very simple to understand. So that's the whole point of futures, is to make that more efficient, rather than people turning up and saying, well, I want a contract for this much grain, and then not being able to sell it because no one actually wants an equivalent. So that was where they all developed from, predominantly grain markets in the US. I know there are futures back in rice markets and things like that, but that's been the original, and sort of that's where the standardization came from grain markets in the US in the 1840s-ish period. Not majorly important for you guys, unless you really want to go into the history of futures contracts. So yeah, otherwise they're forwards. A forward contract can have an impact on the market, but you're probably unlikely to actually see that happen. And the way this would happen is someone would perhaps, a bank would say, sell a forward contract to someone for a very specific quantity, and then what they will do is, because that effectively puts the bank in a position of being short, the bank then will hedge that by buying the futures that make the equivalent to the contract that they've just sold. So you can get forward contracts influencing futures, but to know when that's being done, to know what someone is trying to do to hedge, can be very difficult. So it's more, you might see a little bit more volume come into the market, or a bit more flow, but why that is, you don't know, and it could well be hedging of forward contracts. And that effectively is what futures are always used for some kind of hedging. As I said, they expire monthly. Do you all know the month symbols on these contracts?
Not on top of my head.
No. Commodities, I'm going to leave you guys to find out, mostly because I don't know them off the top of my head. But the main months you'll want are March, June, September and December. So they're H, M, U and Z. So the months prior to March are F and G. J and K before M, and then you have N and O after, and then you have U, X, W, and then Z. So I do know them, just about. But they're the main ones you're going to want. So predominantly everything you trade now is going to be H contract for the March one. As I say, they all expire quarterly or monthly. The expiry dates vary with contracts, so you do have to find that out. Equity contracts expire on the third Friday of the quarter. Bond contracts expire on the second Thursday, I believe. Currencies are, I believe, also the third Thursday. And the commodity ones vary depending upon commodity. Oil, for example, is 3 trading days prior to the 25th, which is awkward, because if the 25th falls on a bank holiday Monday, the oil contract ends up expiring on like the 15th of the month, something like that. So stay very aware of that, because you do end up in quite some trouble if you're stuck in a position. If you get stuck in a position at the end of the contract, you've got to either deliver it or take delivery on it. And it has happened. I've not seen it happen, but I do know of stories of particularly the non-cash settled contracts. We'll come on to that. But the non-cash settled ones, you will get it. And I have heard of lorry loads of cocoa turning up at offices and things like that. It's predominantly only the commodities that you get the cash settling, the non-cash settling. So yeah, you could end up stuck with lorry loads of cocoa that you've now got to put into storage and then sell the contract for the next month and then ship it. So even though you might be able to sell it for a higher price, the fact of all that storage cost, movement, etc., you're going to get screwed on it. So don't get caught out. Oil contracts can now be cash settled, but if not, you don't get the oil. The oil goes to a delivery point and then you have to pay storage on it at the delivery point. It's highly unlikely this is ever going to happen to you. You should be told by your clearer beforehand that positions are coming up to expiry and you need to get out. Also, you'll notice it in the volume. You guys will still be trading come the March rollover. And what you'll start seeing is you'll see the volume shift in contracts. It will shift into that June contract. And it varies. US equities, for example, their volume will switch the Friday before the roll. European ones, the volume will only switch Thursday afternoon before. So you can trade European March contract right the way to the day before. US, you can still trade it in that final week, but the volume is very much in the June contract very quickly. I don't know why you have that situation, but the Europeans seem to like to leave it right to the last, and will even still show respectable volume on the morning of the roll, despite the fact that FTSE will roll at 10:15 in the morning and you could still trade that contract in the morning. So yeah, watch out for that. But unlikely you're ever going to get delivered on some of these things, partly because a lot of the contracts are very obscure ones, things like London cotton and sugar and things like that, which are very thinly traded, and so don't really offer that many opportunities. I think there still seem to be markets that are very sewn up by people who are actually in the know, so people who do still have something to do with the production of sugar, etc. And a lot of the big producers, so people like Cadbury's will have a sugar trading department, and cocoa, they're not Cadbury's anymore, are they? They're Kraft. But it's predominantly people like that that are going to be trading these markets, not so much your individuals. If they're cash settled, what happens is you still have to deliver the amount of cash equivalent of that contract, which does then put you in a little bit of a problem, because not everyone necessarily has the cash equivalent of the value of your futures contract in your trading account. And so even though effectively you would deliver 200 grand and get back 200,050 pounds, you've still got to deliver it, and that's where you can get in quite a bit of trouble. Also, a lot of clearers, because they don't want to go through the process of the delivery, will actually often fine people for it. So not only are you got to take that money out of your account, you're likely to get fined by your clearer for it as well. So just a little warning, but I don't imagine that's going to be an issue for anyone. Right, moving on. Got a question? Aren't they automatically roll over, the clearinghouse, I mean? As far as I know, no. They won't necessarily automatically let it roll it over, because the fact that you might actually want it. You might want to take delivery of that commodity, of that financial instrument, because with a lot of them, whilst cash settled, you do still have the option to ask for the physical commodity, or in the case of bonds, to ask for the actual bonds. So I don't believe they would roll it because of the fact that you might genuinely want it. You might want for, I don't know, your pension to actually have 100 grand's worth of T-notes, for example. So I don't think they would just roll it over. But you'd probably get in a bit of trouble for it. Anyone know anything about fair value? No. Okie doke. Right, effectively it's the difference between the futures price and the cash price. Now, is this majorly important? Not massively. What they will do though, and you'll see it quoted on CNBC and Bloomberg and things like that, and what they quote fair value as is the move in the futures overnight. So say, I don't know, the S&P shuts at 56 and the futures are now trading at 52, they say it's a fair value of -4. Let's say -4 or +4? -4, I believe. So, and the point being there that they're suggesting that's how far the S&P is going to open away from where it closed. So that's one way of them using fair value. But essentially, there is a fair value at all times between the futures and the cash price. Reason for this is that futures offer no return, basically. So if you own a futures contract and you actually want it, you want to hold this until expiry, you have an opportunity cost there, because of the fact you could take the money that you are using to buy the futures contract with and put it in the bank, or buy a specific bond with it that yields a certain amount of money. But in holding it in futures, you don't get that. You don't get any return on it. You won't get dividends on the stocks if you own stock futures. Commodity futures is slightly different because commodities don't give you a payback anyway, but you've then got storage costs to factor in. If you're owning the futures, you don't have to pay the storage cost yet because you're still waiting. However, the other side of that trade will have to pay the storage costs, so that will push the prices up. So generally, futures will often trade slightly higher, certainly in commodity markets, than the actual underlying cash, because of factoring in that storage. Now, why is that important? Why is it worth actually knowing this? The reason is, every so often, and it's quite rare, you will get a futures exchange will shut for some reason. Maybe it's a software issue, maybe it's excessive volatility, all sorts of different reasons. Futures exchanges do every so often shut. Now what will then happen is the futures exchange has got to reopen, and it can happen whereby the futures don't open in line with where they should be relative to the cash. So if you know that the difference between Eurostoxx cash and Eurostoxx futures is 4 ticks, for example, and so futures are 4 higher than the cash, and they open 20 higher, you know you've got a real easy trade there to sell the Eurostoxx on the open. And I never like to say it's free money or a guaranteed trade, but it's as close as you're going to get, because the cash market's still trading where it is. Anyone who's got access to the cash market can just buy the cash market and sell the futures market, and they've immediately locked themselves in totally risk-free money. From the point of view of us, you know what's going to happen. You know that people will do that trade. You just take the one side of it and sell the cash market, sell the futures, which should then come back in line. So whilst not majorly important to your day-to-day trading, having an idea of where it is very, very useful, or having a cash chart that you can bring up is very useful. So if you do ever get a situation whereby the exchange goes down, the first thing I'll do is check where the cash was trading at the same time as the futures went down, work out the difference so you know that wherever the cash isn't trading when it opens, that's where you should be opening. And it has happened. I've seen things like the DAX open, say 20 ticks away, which is your opportunity to then put on a lot more size and take that trade. So this is where, Victor, you don't want to trade a 2 lot or a 1 lot. That's where you want to go all 10 and take that trade on because you're unlikely to get another trade that's going to offer you such tight risk reward. It shouldn't go against you. Shouldn't. And that's the point. It's never free money, it's never guaranteed money, but it could happen. So yeah, that's the point of fair value, why it's useful to know. But otherwise, on a day-to-day basis, I couldn't tell you right now what the fair value of the DAX is to the cash, but if the exchange goes down, I'll look that up pretty quick, just so you're ready for it. So yeah, it's a lot of the things that you sort of need to know or are useful to know are for the more exceptional circumstances, but the exceptional circumstances are the times when there might be a massive opportunity, and as long as you're aware of that and up to speed on it, that opportunity is there for the taking. Whereas there's going to be other people scrambling around, it reopens, it jumps up a little bit, and they're like, why is it doing that, and try and go against it, and you know that it shouldn't be doing, they shouldn't be going against it. So it gives you more opportunity to trade, basically. So yeah.
I think it was like a few weeks ago, probably like 3 weeks ago, when the Eurex was down.
Yeah.
When
did Eurex go down?
Yeah, I think so.
Okay.
I mean, no, it was not down, but the open was delayed. I think it was only the futures open. So it closed properly the previous day, and then the futures open was delayed. I think, it opened actually before the cash opened, so everything was...
I do vaguely remember that.
Yeah, it was relatively recently, I think 4 weeks, or something like that.
Maybe. I was away 3 or 4 weeks ago. So it could have had, but I have seen that, where the futures get delayed on the open for a while.
Yes.
I can't remember. Yeah, that was some technical issue.
Yes, it was, some glitch stuff, yeah.
But yeah, that could have ended up seeping into the cash market,
Yes,
and that's exactly when you'd need that. And then I'd just compare where it was on the close the previous day. And often that's the easiest way of comparing it. Just go from the close to the close. And it'll give you, it does change every day, and it will sort of progress as the months go on, so it is different every day. But yeah, that would have been a perfect example of when the opportunity was there, but opened a little bit too soon, unfortunately. There you go. Right, moving on. Have you all heard of most of the major futures exchanges? Traded on most of them. Cool. The majority of things that you trade, particularly during this, is probably going to be on Eurex, CME. There's not a great deal on CBOT. That is Bitcoin now. Don't imagine you guys are going to trade too much Bitcoin. When you get your sims up, you can have a look at it, but it's not very tradable. At the moment, it's trading about 1,200 lots per day, which is not really tradable. It's extremely thin, so not really one. But apart from that, CBOT has US bond markets is probably the main thing. That's the main attraction to CBOT. And then CBOT's got things like grain, wheat, corn, all those kind of contracts on it. COMEX is metals, NYMEX is oil, gasoline, heating oil, natural gas is all on NYMEX. And then ICE took over from Life a few years ago. ICE now has Brent oil, all those kind of more European oil markets, and also has all of the UK products. So it has FTSE futures, gilt futures, and a lot of short end things. So on ICE, and we'll talk about short end a little bit later on, but they all have the short sterling, the Euribors. They're the main two, short sterling and Euribor on there. So they're useful at times. I don't watch. Do you all know what I mean by short sterling and Euribor? Sort of. Yeah, basically it's very short-term interest rates. So where banks can sort of trade. It's 90-day money, Euribor, and it's 30 days. So they run on a 1-month contract, and it's basically for interbank borrowing. It's interest rate futures basically, so you can hedge your interest rate risk. These markets are extremely thick. You'll get sort of 20,000 bid and offer on them, and they will have a 3-tick range in a day, maybe something like that. In fact, I'll bring you a. Let's have a Euribor. You go. Yeah, that's the excitement of the day so far. We've got 170,000 on the bid, and we've got 30,000 on the offer, and that is the range. And also, it's only traded 30,000 lots, so you may not get filled there all day long, and that's it. And that's December Euribor, so that's for hedging your interest rates later on this year. So theoretically, that should be more volatile because of the fact that there's a lot more risk of interest rates moving by the end of December this year than there is, say, next month. But nonetheless, and we'll come on to it in a bit more detail when we do central banks, we know the ECB is not going to raise rates anytime soon. So actually, it having virtually no range is quite understandable. So that's the other thing on ICE. So really, ICE only for FTSE. Unfortunately, you guys don't get ICE on the sim, so you will miss out on FTSE, on gilt, and on the excitement of Euribor, which is a thriller.
What was short sterling?
So short sterling's the equivalent, but for UK interest rates. And then in the US, you get confusingly euro dollars, which are not euro dollar currency, but euro dollar sters, which are the same. They've generally got more volatility in them. When I say more volatility, they might have a 6-tick range, but they've got a bit more in them. Partly because US interest rates are, one, more widely traded. There's a greater number of products that use them to hedge as well. And US interest rates are actually moving. Little bit, but they are moving, whereas European are going nowhere. UK rates might be moving a little bit. Certainly might be tomorrow. But no, not tomorrow, Thursday. I don't think that we're going to get any movement on Thursday. But so they're the main markets you're going to want. Like I say, unfortunately, you won't be able to trade ICE, which isn't a major loss, I don't think. The one thing I would suggest is worth being able to watch on there's FTSE, but that's it. In terms of FTSE, I only really use it to trade the closes. I started trading a little bit more technically, but the original reason for trading FTSE is because a lot of trade gets put through on the close. So FTSE can have quite a pickup in volume and occasionally does get quite a bit of flow in it. So we'll have a talk about that when we get on to the sort of price action week, and we'll go through where those opportunities are. So the very time-based opportunities on closes, options. There's a few different things, auctions as well, and that's where price action tells you more than any kind of technical plan or technical setup. So we will have a look at that as well. Can we predict that from the imbalances that are 5 minutes to the close that fair value will have a difference? Right, I think I know what Pete's talking about. So Pete's talking about you will often get an imbalance coming into the close. And this, we'll go into this in a little bit more detail later on. But what you will get, particularly going to the S&P close, and someone mentioned Mr. Topstep earlier. Yeah,
That's a different thing. No, I know.
You know what I mean, on Twitter, and he would give out the closing imbalance, and it'll, you'll get something like it's 2 billion to buy into the close. Theoretically, this would mean that 2 billion worth of positions need to be bought into the final 5 minutes or final 2 minutes. Can you actually trade off that? Yes, but it's still not a guarantee that the market's going to move in that direction. So for me, I wouldn't ideally. But in answer to your question, Peter, no, I don't think that has a great deal to do with the fair value. It might shift fair value momentarily, and that's where you could see it coming back. So, because when you've got, say, the 2 billion to buy, that's going to be in the cash market. So you could see the cash push up into the close, which doesn't necessarily mean the futures have to. If someone really wants to sell the futures, you get the futures go up by not as much, and then eventually that might sort itself out and catch up. But that can then become quite a tricky one to keep trading, because once the cash is shut, yes, the fair value was out of line at the close, it might not be by the open the next day, but that could be by virtue of the cash market opening back down here. So whilst yes, you could use it if it creates a sort of divergence in the fair value, how that gets rectified could either be by the futures doing the side of the trade that you could trade, i.e. catching up to it, or it could be done by the next day, the cash moving in line with the futures. So the futures could go and do what they want all night, the futures could keep going down, and then the cash just has a bigger drop and matches up with it come the open. And so whilst you've said, well, yeah, there's 2 billion to buy and the futures should catch it up, if they don't come the open, that 2 billion to buy in the cash is basically just bad positioning that then gets unwound on the open. So I'd be a little bit wary of trying to play that one side of the spread, particularly when the cash market, which is the one that should drive it, has actually shut. So that makes sense to everyone.
Yeah.
Cool. Right, so they're your main exchanges. I've got a big list of contract symbols here. I'm not going to go through them all one by one just now. But what I will do is I will put this spreadsheet on the group so you guys can all keep it so that you know contract names for everything, because it's a bit quicker and a bit easier to just go and flick them up. The contract codes are for, you'll be all right because it's all on TT based, but a lot of charting systems don't use the same contract codes, which is extremely annoying, but that's the way they do it. So for example, my charts DAX is XG, my ladders is FDASX, FDAX. So I've got all of those there for you. What I'm also going to do for you, friendly like that, give you a nice bit of homework, and you can look up your own contract specs of the size of the contracts and the tick size, which is obviously very, very useful to know, because it can have a bit of influence on what you trade. The most confusing ones, tick sizes, are the US ones, because the fact they still use the old school imperial measurements of doing things. So just for example, the ticks on a 10-year T-note, it works in 30 seconds. So you're trading at 112 and 330 seconds rather than just decimalised like everything else. But not only that, just to add to it, it's 30 seconds and then halves of 30 seconds as well. So you will get the price on the T-note quoted as, say, 112.23, and you'll get a 5 at the end for a half, which is very frustrating. And then just to add to it, if you do trade 5 years, it's traded in quarters of 30 seconds. So your tick size, whenever you look anything up, will relate to a whole tick. So in the T-notes, you could halve that, and every individual tick is half of the amount. But yeah, generally a lot of them trade in reasonably nice, neat decimals. It's just really the US bonds that come up a bit obscure. So yeah, I'll put that on the group afterwards. I'll let you go and look up the contract specs. Easiest way to find them, go onto any exchange website, type in contract specs of whichever contract it is, and it will tell you the size of the contracts, the maximum bands with which they'll trade in within a day, tick sizes, all the rest of it. So it's all there. Yeah, one thing I just mentioned on maximum variance within a day. A lot of markets, the US markets, will have a limit on how far they can move. Circuit breakers, they call them. And basically what it means is if the market trades down to a certain price, it can't then trade any further below that price until they have an auction, and then they let the market trade again. And so these go down, I think, in increments from 7%, 12%, and then 15%, something like that for the US. Eurex products don't have that. They have volatility stops. So when the market gets too volatile, it just all of a sudden goes bang and stops. So you don't know when that is. That may not be a certain distance of move. It may not be, it could be a move up or down. And they're not clear on what it is that triggers that either. So I believe it's to do with a wide enough bid and offer spread opening up and the speed of trade. It's a few different factors like that, but Eurex will shut, so you don't have a price. Whereas with, say, the S&P, you can find the price that is the limit for that period.
Is it happening for US? I remember last time it was probably during the US elections when S&P was
S&P,
down.
yeah, S&P hit the limit on the US election.
For Eurex, is it actually like in the, let's say, during the Greek crisis? Was it?
We've seen it a couple of times. Yeah, Greek crisis. I've seen the volatility stop. It's done it a few times on ECB decisions. ECB minutes in the thinner market, so things like OATs and BTPs.
But then how do you know that it's actually, let's say, in the context of Eurex, limit down, right? Because in US you actually know the number, right? In theory you can calculate that it's limit down, so it cannot go lower.
Yes.
Because I remember during the Trump election,
Yeah.
I read on Twitter someone posted that this is the limit down for S&P, and actually went to that level and
Yeah.
bounced. But if I didn't have that knowledge, I wouldn't know it.
No.
So how do you know for Eurex that it's actually locked?
Um,
Or they're actually stopping the exchange, or how is
that's what will happen. So all of the bids and offers will just disappear.
And if you have open position, then you just...
You're stuck with an open position. And so what you will then get is you will just have a little box that moves, and the little box indicates where it will reopen, but you don't know when it will reopen.
Right.
It might be 10 seconds time, it might be 10 minutes. You don't know. You don't get told, and then it reopens. Which, yeah, I feel in a way actually goes counter to the volatility, because then creates panic,
Right.
because people then have got positions that they can't hedge, they don't know what to do with, and surely will then create more volatility in the underlying
Right.
as everyone scrambles to hedge. So yeah, I don't really see what the real basis of it is, but that's what happens. And again, that's where understanding fair value is very useful, because that can happen. Yeah, we've seen it in fact, I've got an example of it which we'll do in the events week on the oats. Did what is referred to on the floor generally as a white box, because that's what happens. It just shuts and you get this little white box that moves. So the oats, after the French election, opened, did a white box down, then a white box back up. So depending upon your position, you could have got away with it. That you would have watched the market, say if you bought it, put you way offside, open, and put you straight back onside, and then reopen onside. But you have very little say over this, and it is scary if you get caught in a box. But that's where you then have to move and try and do something about it, and you'd have to go and hedge it. So what I would generally do is pick an equivalent market and go the other way in that market. So you would probably, anything in the bunds you would probably do against T-notes, or if you could do it against Bobble or Shaps, you would go there. European equities, S&Ps or FTSE, and just take the trade the other way. Occasionally you can get very lucky on that. I know a couple of guys who on a US rate cut bought the DAX shut, so you got a white box, sold the FTSE to hedge it. By the time the DAX reopened, the FTSE was on side, so take the winner from the DAX, and then the FTSE was basically on side and gave them a free trade, so you just put a stop in and let it go.
After how long it reopens, it depends.
It's yeah. Basically, what happens is they aggregate all the orders that are in the market. So you can put your orders in. You can't necessarily see. You can't see any of the other orders, but you can put an order in. And then once they feel that they've got enough orders that aren't moving around, they'll then reopen. But you don't know when that is, and you don't get told either. Yeah, there is a strategy for it. If you are stuck in the box, i.e., say you're long, and the market goes up and then shuts, and all you can see is the little box above you, and so you know you're up, but you don't know where it's going to open. I would always put half my position for a scratch, because if you put an offer below the box, it will sell the box. As soon as it reopens, you will get whatever price it reopens at. So at least then you guarantee you take half your position out wherever it reopens. And then it's a situation of what happens. Say a market has shot up on a piece of news, you know that the majority of people are long because of the news. Therefore, the moment it reopens, are going to try and take their profit. So as soon as it reopens, it will probably shoot down. So you can actually have a trade on it, and even if you're not in a position, you could sell the open with the expectation that people will take their profit and it will shoot down. So a little bit of trade psychology there for you. So yeah, they're the main contracts that I imagine you're likely to ever come across. Can anyone see anything that they have traded or want to trade that's not there? I don't think there's anything. No. No, don't think so. In terms of currencies, and we'll do this tomorrow. Yeah, tomorrow, I think. No, not tomorrow, Wednesday. Currencies, pretty much everything is against the dollar, just because that's what everyone trades against. Euro Swiss has a little bit of volume in it. Euro sterling, even less. So yeah, there's not a great deal of reason to want to trade anything that's not against the dollar. Which means that the majority of these all move reasonably in parallel, but obviously vary based on different factors in the individual pairs. Right, I'll send you that over in a little bit. Right, futures for hedging, and this is really the way that everyone uses them. Effectively, the whole idea is that you shift your risk to someone else, and from a company's point of view or a producer's point of view, that's half what you want to be doing. You don't want to be exposing yourself to market risk. It's people like us that do, and that's where your local traders come in. And the whole point is that we will effectively take their longer term risk into a shorter term perspective. We're happy to take that risk on short term, shift it on to someone else short term, shift it on, and ultimately the producer or eventual buyer of these things gets their long-term risk hedged for them, and we just move it around until someone else a bit more longer term wants to take it on. So that's the whole point of futures. Like I was saying, it is a longer term thing, so it is for the producers, whoever, to lock in these prices, and it locks in your cash flow. You know that you've spent this money now, whereas if you wait and wait and wait, yeah, you might get better prices, but if it doesn't work out, you now have no cash flow to pay the higher prices, so you end up either buying a lower quantity or missing out completely. As a basic, quick way of looking at things, anyone who's producing something is naturally long, so they are always going to want to sell futures. Anyone consuming is naturally short, i.e. they don't have it, so they are always going to be the buyers. So just a nice, easy way of sort of thinking about it. But in terms of how they would transact, it's always the opposite to what you naturally are, because you want to counter that. If you're naturally short of something, your risk is that you don't ever actually have it, so your incentive is to be long it to cancel that risk out. Effectively, same with producers. They naturally got it, they need to sell it to lock in those prices. We'll have a look at that as an example in a minute. The other thing that they're used for, and this is more from a financial perspective, is for hedging positions in underlying markets. So those forward positions, for example, bond auctions are another good example, whereby if a bank is selling a bond, they own the bond, so they are naturally long it. They then sell the bond, so they sell it, which effectively puts them long because they're selling it for someone. So if you're a corporate, and we'll come on to this in a bit more detail, but basically if I want to sell bonds, I'll go to a bank and say, can you take all these bonds, and the bank sells them. So effectively the bank sells the bonds, which then makes them long the bonds. They then need to hedge their risk. So there's to manage those kind of risks. There's also the side of, say, if you own equities, so you own a large portfolio of equities, and there is some kind of potential risk event, i.e. the US election, Brexit, something like that, you could sell futures overnight to mitigate that risk. So if you had a large US stock portfolio, you could sell a couple of S&P futures against it. And then, if Trump gets in, it goes limit down, at least the money you've made on the futures has covered the loss that you're taking on your overall position. As it turns out, as long as if you employed that strategy, took the profit on the futures to cover that loss on the underlying cash, you've actually done very, very well, because it's kept you in your cash position, which is now miles and miles and miles on side. That was, in hindsight, one of the best buying opportunities going. It never went back there if you bought it on that limit. But that's a very dangerous game, buying the limit down, because the fact that if it gets locked on the limit down, the next day it can go limit down again. Doesn't happen in equity markets and bond markets really, because of the fact that for that to happen, you've got to see massive amounts of valuation wiped off companies that perhaps for no reason are going to be in that situation. Whereas commodity markets, it does. For example, the much more spoilable commodities, things like orange juice, etc. If someone's got a massive glut of orange juice and they're going to sell it, if they don't get some price for it, it's worth nothing. So they will be happy to sell the futures and send it limit down, limit down, limit down, say 3 days in a row, which is a dangerous situation to be in, hence why you never buy the limit. Or you take a big risk on Trump, buy the limit, and it never goes back. I did try and buy the limit on Trump a couple of times. The idea that you buy it and as soon as it goes back to the limit, you get out straight away because you don't want it to trap you. And so I tried to buy it a couple of times, and then eventually it didn't go back and then kept going, by which point you sort of scratched. So very difficult one, a very dangerous game to play. So yeah, that's the other main, and there's a nice example. And just an explanation of what I just explained. Perfect. Right, a little bit of an example for you. Thought I'd just draw it just in case it's not been too clear to everyone. So I always use the, not a baker, a farmer and a baker example. The example of wheat, basically, that you don't know what the price is going to be. But the point being that if the farmer wants to buy his wheat for 100, he wants to sell it for 100, he's already long, so he's happy to go short at 100. And it doesn't matter for him where it expires because he's already got his 100. So if we expire here, it's all looking good. If we expire here, not so much. And that's the risk that they're quite happy to take. In a sense, you're risking opportunity by banking your profit there. And that's perfectly acceptable. But if, say, you end up expiring down here, the farmer has now ended up making no money for the year because the fact that he needs it to trade to be at least above, say, 90 to actually cover his costs. So that's why they'll be quite happy to sell it at 100, lock that in. They're very happy with it. The baker, on the other hand, of course, is naturally short, so they're going to want to be trying to buy it at lower prices to try and sort of guarantee their cost of production going forward. Excuse me. Now, in terms of where we come into this, ultimately, you just end up with a situation of, because the farmer's not going to sell it straight to the baker, the farmer sells it to trader A. So the farmer's gone from long, so he's now neutral, and now the trader is long. He then sells it on to trader B, who's now long, and it goes on and on and on like that. And this could be a case that one of them wins, the next one loses, and it all, from a trader's point of view, comes down to how long you hold on to those trades. It could be the fact that he was long, sold it to the next trader who thought that the market was going to continue going up. It doesn't. So eventually he sells it, and it moves all the way along until we get back to the baker, who then gets his chance to buy it as well, because the market's now moved lower. One trader is long and he's panicking, and the baker decides, actually, this is the price I want, gets in and takes it. So that's how it effectively works. Now, in terms of what this means trade-wise and movement-wise in markets, people like the farmer and the baker are going to be much more big-scale companies. They're going to be people like Shell, like BP, like, for example, Nestle in the more commodity markets. There will be people like BlackRock and PIMCO in the bond markets. And so they're not going to be buying just at $100. They will say, right, we've got to buy this much. So say if it's oil, for example, and a big consumer of oil needs to buy, they might decide, right, we are going to buy between $60 and $65. And the aim there would be that they want to get it as close as they can to 60, but they will happily pay up to 65. And so this will then go to their trading desk, excuse me, and their trading desk will be given a certain number of contracts that they've got to get. So I don't know, maybe they've got to get 20,000 contracts off between those two prices. That's quite a big range, actually, to do 20,000. Let's call that 2. So yeah, they'll have 20,000 to do with those prices. So it won't be that you'll just get a 20,000 bid at 60. You'll get a consistent buying within the market. And it could sort of manifest itself as you will see, say, a lot of buying at, say, $60.20. And then when no one sells it there, they'll move up and they'll pay $60.50. And then $60.75, then $61. But you will get this consistent bid that stays in the market, consistent sort of buying within the market. So that's more how they will actually get these things done. It won't be that they're just going to turn up and go, right, I want it at this price, and yeah, they'll just sit there and hope to get it, because they won't. No one's going to see someone with a 20,000 bid in a market that's got 20 lots on both sides and go, oh, okay, I'm going to sell it to them, because you pretty much guaranteed you're going to lose there. So yeah, there will be a lot more skill in it, but a more concerted bid in the market, and you'll be able to see that flow sometimes, that sort of consistent, almost grind of a market higher. You'll often get that sort of grinding trend days. So whilst the trend seems very good and you're like, yeah, it's going to be a trend, it's going to be amazing, often it's because of something like this, whereby there's not a rush to buy, it's just a consistent willingness to buy. And that's where Profile's brilliant, and we'll talk about that later on. You can kind of see that in a lot more detail on a profile, and it's able to sort of tell you effectively that that's going on. Whoops. So yeah, that's how they'll basically do it, and then individuals, not so much. You will take whatever price. You do see it occasionally in markets, and we'll talk about this again when we do sort of more price action, but front running where effectively someone's been given this kind of order and they've gone, okay, we're going to buy 1,000 at a time. And what they do is they just go bang, 1,000 on the bid, and everyone runs away from it and it jumps up. And then they move the 1,000 up and up and up and up until people decide, actually, this is now out of line with, say, Brent. So you can sell into the 1,000 and buy Brent and take the spread. So often you would see situations like that whereby you will see a large order actually chase the market. And that's generally a broker or someone on a desk for a larger company that's decided, right, we need to get this done, and they will just come in and chase. And there's opportunity in that. But yeah, that's how the bigger people will get their positions away. Individuals, there's a lot more, I want to buy that price, click, and that's about it. So yeah, that's effectively how things get hedged between the two. And it's the same principle. If you've got an underlying position, you will then hedge it whichever way. The danger with trying to use futures to hedge like that is that you're still exposing yourself to a large risk on the underlying, on the futures position. So say you've got, say you're a pension fund, you're PIMCO, and you've got a large bond position, you fear that something's going to happen over the weekend. Maybe there's risk of an interest rate hike. And so you sell fixed income futures. So you're now long the main stocks, short the fixed income futures. Long bonds, short the futures. And what ended up happening is the futures then go against you, but they go against you further than your bond portfolio because of the fact that the futures are a standardized thing. You can't have an exact match of what your portfolio is. You can only have an approximation. So you still run the risk of actually losing on that futures hedge. So there is a little bit of risk in it. It's not major and not something that we're likely to ever come across, but you could accidentally over-hedge things. And it's more often that over-hedging that causes a risk. And we'll look into that when we do government bond auctions. That's an area where banks can very easily over-hedge themselves and get themselves in a fair bit of trouble. I say trouble, get the position in a little bit of trouble that then needs sorting out. You're not going to get a bank bankrupting itself on a government bond auction, but you could see a bit more flow coming into the markets. Any questions so far? Nope. Peter? Nope. All good. Right. Right, leverage and margin. And this is why futures are so much better in terms of day-to-day trading than most other things. If you're trading individual stocks, it's extremely difficult to make money because you need to put in a huge amount of money to start with. And also transaction costs in stocks are very, very high, generally. So the whole point of leverage, it comes from two things. One, it comes from your contract size, and two, it comes from your margin. So use the example of oil. I think this is probably the easiest example to use. But effectively, one contract gives you 1,000 barrels of oil. So every contract you buy, you've got effectively control over 1,000 barrels of oil, which is 42,000 gallons, if you needed to know that. But that's what the contract spec says is 42,000 gallons of oil. And so, say oil was trading $50 a barrel. I used this example a little while ago because it's now trading 62, 63. One contract's worth 50 grand. Consequently, you only need a 1 cent rise to make a tenner on that because of the fact that you've got 1,000 barrels at that 50. So that's where your leverage comes in. You then have margin as well. So you don't have to obviously pay the 50 grand. You put a certain amount of money up effectively to guarantee that you're not going to default on this, that you've got enough money. And the theory behind the margin is that oil is unlikely to move by a certain amount within a day, therefore your margin should not get wiped out. So you don't need to put up all the money, because unlike, say, a bet on a football match, which is a lot more binary, if the result isn't the result, that's it, you're done. So it's almost like an in-play bet, whereby you have an amount that you could cash out of. So yeah, the margin is usually between 5 and 10%, depending upon volatility, depending upon exchanges, and the amount of margin varies massively. So things like oil have around about, and it'll tell you on their website, somewhere around about $6,000 margin per contract. Things like DAX, I think last time I looked, it was 20,000 euros for one lot. That's for overnight margin. Intraday margin's a lot less. So you pay an intraday amount of margin, and then overnight margin you have to top up to the full amount. Excuse me. Bond markets, because of their lower volatility, because the fact that they're government, like bonds are obviously government backed, there's a lot less chance of them having extremely excessive moves. So bond margins are generally much, much lower, which is interesting why retail guys aren't pushed more to trade bonds, because they're generally lower risk. Margin is significantly lower, yet foreign exchange margin is still reasonably high, because things like euro, yen, things like that are very, very volatile at times. So yeah, you have an initial margin, which is 5 to 10%. You then have a maintenance margin. So even if your initial margin is 5 grand, if it drops below 3.5, you'll be asked to top it back up. So it's basically the amount that you're allowed for it to drop to. So in a sense, your margin is not your margin. Your margin is the margin until you hit your initial margin. And then you get a margin call. Now, where this can come in useful, or not come in useful, but knowing about margin calls, is the fact if someone gets one, how do they deal with that? They have to get rid of some kind of position so that they can pay the margin, basically. So either they will sell out of that position, or they will sell something else to cover it. So it could be you then see a knock-on effect in other markets, and you suddenly see a massive sell in, who knows, something else that someone's holding that portfolio in. They could sell those markets in order to pay the margin on a different market. Also, with margin, it can be upped by exchanges virtually at any time as well. So again, this can then create a margin call across the board rather than on one firm's position. It could be a full everyone margin call, which can then again generally create a sale whereby people are going to get out of positions to pay that margin, particularly if the market is generally long. So that's where margin comes in. But effectively what it means is you only need 5 grand to own 50 grand's worth of oil. So therefore your percentage win is a lot bigger. And that's where you leverage, and that's where the, I say excessive, it's where the extra ability to earn comes into futures, and what makes them that much more desirable to trade than individual stocks. Despite the fact individual stocks will move percentage-wise a lot more generally on a day, but still it's quite difficult to actually trade them, and the commission cost is still very, very high. All right, so your tick value, this derives from your contract size. You've already got the spreadsheet, so you can go and look up the specs yourselves, but effectively the tick value does derive from the contract size. So in the case of oil, because you've got $1,000 and it is priced per cent, so 62.20 or whatever it's trading at the moment, that works out as $10 per contract because it's 1 cent increments. So in terms of commodities, it's the amount of the commodity, so it's 1,000 barrels. In terms of equity markets, it's done on a basket. So the exchange will decide the value of that basket. So take, for example, S&P, which is trading currently at 27.42. CME decides that an S&P contract is worth 50 times that. So the contract's not worth a certain amount, it's worth 50 times the price. And so that becomes the size of the contract, and then they decide on the tick size. So because it's 50 times the price, every tick is worth 50.
In theory, like one of every share.
Yes, theoretically it's a basket, so it'll be a weighted basket as well. So because not every stock is the same pricing levels, you would then have to own a certain number of every stock, which, to do as a hedge would be exceptionally difficult to work all of that out, buy all of the stocks in the right denominations.
Is the weighting based on market cap of each and every company?
It varies by market, in terms of whether it's market cap or price. S&P's market cap. So you would need, if you're trying to hedge S&P futures, probably to own more Apple shares than you would Monsanto shares, someone like that, to make that up. But also, S&P's got 500 companies in it, so you've then got to buy 500 stocks at a transaction cost of maybe $10 a stock. Just buying the stocks to hedge your position is probably more than the margin on the futures. So not something you're really going to do unless you already own the stock, so you're unlikely to hedge the other way. And then bonds have a face value at maturity, so all the bond markets will have a certain price, basically. T-notes, for example, the notional value of a T-note future is $100,000. Bund futures and European bond futures equally are 100,000. The shorter end ones are generally 250,000. So that's your notional value. Currently, your notional value of an S&P contract's 5 times 27. So anyone particularly quick at maths will know that that's 130 something. Sorry?
5 times 27, you said?
Yeah, 135.
Yeah.
So 135,000. FTSE 75,000 now. DAX is 25 times, so DAX is the big one. And it's 25 times 13,000 at the moment. So DAX is a very, very big contract. Hence why not that many people trade it, because it's so easy to get caught out very, very quickly. If it's 25 euros a tick, when it does currently today, it's done a 142 tick range. So it's probably that's the drawdown with the DAX. It's one of the biggest contracts in terms of value, and it's also one of the biggest contracts in terms of daily movement. So the last 3 days it's done 350 ticks, 300 ticks, and then today it's done 140. So
So usually, what in terms of size, because you trade DAX futures.
Yeah.
So in terms of size, what kind of size are you comfortable, trading from a liquidity perspective?
liquidity perspective, I don't think you're going to get yourself in any trouble until you're really trading more than about 10. But yeah, it's pretty low before you can get yourself in too much trouble. In terms of generally intraday, I think 2 or 3 lots you can do very well, just on 2 or 3 in the DAX. Interestingly, mini DAX is starting to get a lot thicker. Mini DAX is €5 a tick, so it's much smaller contract, but it is now starting to do a bit more volume. It's more liquid, so you're getting say 20 lots bids and offers in mini DAX, whereas big DAX you're rarely seeing double figures, which makes it quite a dangerous market, but you can do the size in the DAX. You've just got to scale yourself into those trades a little bit more. Whereas, yeah, you'll get filled. Basically, if you decide I want to trade a 20 lot and you put 20 in on the DAX, you'll get filled. But if you want to get out, it's more difficult. You try and hit market and you're going to take prices out. So, yeah, it's quite a scary one if you've got more than 10 lots on, really. And you could do a lot of damage with 10. Yeah, do a point with 10 lots and it's 25 grand. So, yeah, there's a lot of money to be made in the DAX. Good market. I like it. I like it a lot, but that's me. Quick example, because I always nice to do a little example. There's your clearinghouse. So what happens is, rather than trader A and B actually transact with each other, the whole point is that there's credit risk here. You don't know that trader B will ever actually honour the trade. Whereas if you both go and put your margin to the clearinghouse, you know that the clearinghouse is going to sort it out. So the clearinghouse effectively backs trader B up to a certain amount. So you always know that you're safe there. That's the whole point of it. And the other side of it is because of the fact that you have that little leverage. For example, say you're trading oil and you put up 5k, we'll call it. Oil could move $1 in a day. So even with your one lot, you get $1 move in oil and you've made $1,000 in a day, which is 20%. And that's where the big win is, in the fact that you just don't have that in other things. You know, to make $1,000 on 5 grand is going to take quite a move in virtually anything else. You know, you're going to have to see. Well, you need a 20% move in oil, so 20% on top of 60. So you're going to have to see another $12 move in oil to make that up, and trying to get the trade right and be in it for that is quite difficult. But to be in it for a $1 move in oil is not something that is uncommon. It's not something that you couldn't do on a day-to-day basis. It's not something that couldn't happen within a minute. Oil could quite happily, on a bit of news, on a big break for a level, do $1 in a minute. So you could, 20% win in a minute, which you just can't do enough of things. So that's where the value of futures comes in. That's the whole point of how the clearing firms work. The only risk is if your clearer goes bust, and then of course you're all stuck, which is what happened with MF Global a few years ago, where the clearer was using client funds to trade with, which is frowned upon, shall we say. But yeah, that's effectively what they were doing, which caused a lot of problems. Which, interestingly, it was a guy called John Corzine who ran MF Global, who he used to be CEO of Goldman Sachs and also a US governor. So no matter how your pedigree is and where you've worked in the past, it seems that anyone is fallible to these kind of dodgy trading practices. But yeah, that's the whole point of your clearing firm. And then they would obviously then dish back the money or take a bit more money if you lose. So trader B1, you'll get your margin a little bit back. Trader A will get a margin call for the rest. It's effectively the same as going to a casino and giving them $10 and they give you a $100 chip on the basis that you will settle up at the end and you'll either owe up to 100 or you'll still claim over the top on it. So that's your leverage side of things. Nice and simple. So why trade them? I think we kind of covered this pretty much. Direct access, you got a tighter bid offer spread, and that's the big thing with spread betting. When you really want to trade, generally when there's more going on, when there's more activity, the spread bettors just go, oh yeah, now your spread's 10 ticks. So you want to trade a one lot in the Bund and it's cost you €100 already. The range, for example, today might be, Bund range today's done 70 ticks. So if you're paying 10 of them to get in, sorry?
That's a lot.
Bund, yeah, it's quite a bit actually for Bund. Bund's been moving quite a bit recently though. It's had pretty decent ranges. But yeah, it's basically just got bought straight off the open. Bund interestingly gapped down with equities, which is quite rare. That's quite an odd one to see actually. Yeah, Bund gapped down with equities and then just got bought. And has pretty much gone up all day. So yeah, pretty decent move. But yeah, if they widen the spreads though, and you're paying 10 tick spread and there's only 70 tick range, you're in a bit of a problem. Greater leverage, as we just discussed. Tick size. Tick size is, I think, the problem often with people coming into futures is that if they have traded spread bet, they're often doing £1 a point, £2 a point. Your minimum in futures really is going to be 10. And that, I think, can be quite hard for people to take to start with, which is why test it out on the sim, get used to it, just because when you go live, it's that much more difficult. Everyone does it when they go live. Everyone's round trips drop massively when they first go live. I still remember my first day live, I did 14 round trips. Prior to that, I was probably doing 30 or 40 every day. I did 14 on my first day live. Made 11 ticks, which I was quite pleased about. Everyone remembers that kind of thing. Generally, execution is a lot faster on news and things like that as well. Your ping time to exchanges will be somewhere in the region of 0.008 of a second. So you're as fast as most things apart from Victor's computer programs, which are taking a lot of those opportunities out. And we'll look at that when we do particularly the event type stuff and how you can trade like macro data, news that comes out. You'll see that because of the amount of computer trading, certain trades are just not available. For example, you get a US CPI number, you won't be able to get in the first few prices because you've got to read and interpret. The computer just clicks instantly. So whilst execution is fast, you are still competing with those types of things, and that's where you've got to vary the way you trade. Yeah, you've got to accept you can't win that battle, so go and win the one that you can win, and you win that battle by your consistency and understand what then happens. All right, greater liquidity as well. We'll talk about this when we do currencies on Wednesday. The idea of liquidity, and there's this big sort of hype about liquidity, but often really liquidity never becomes an issue until your size gains a certain amount. unless you are trading very thin things like DAX, like gasoline. Have a look at that when you've got the sim up as well. Gasoline's very thin. Gasoline has still got a bid offer spread generally. It's pretty bonkers. But gasoline tick value is very, very low. It's $4.20 a tick, so it's cheap, but you've got a decent spread. But gasoline will do a much, much larger range than oil on some days. I've seen gasoline do 1,000 tick range in a day, so it's bonkers some days.
Like natural gas.
Natural.
Trade or something, whenever
The
inventory reports come out or something. That's really thin, but that's just.
Yeah, so yeah, you can have a go at trading that. The natural gas number is on Thursdays. The oil inventory number is on Wednesdays. So yeah, we'll have a go at getting those, get you guys to trade those to experience a bit of volatility, things like that. It's worth trading stuff like that just to get used to the volatility, to get used to your eyes just focusing on things moving quite as quick as they do. I think those times do offer you a lot of opportunity, as long as you've got a bit of a plan for doing it. It's the people who the natural gas number comes out and the market goes like that and they go, oh, it's gone up, buy it. And then it goes like that. And then they don't know what to do. So it's sort of, if you know what you're going to do, it's fine. But yeah, if you see it jump up and just buy it, it generally doesn't work. It does on occasion. Certain situations, yeah, there is a valid reason to just buy the high and it should keep going. But rarely, and particularly on the natural gas number, where we talk about that, or I'll talk about it tomorrow when we go through our order types. But I'll tell you a story about using certain order types on natural gas, which doesn't work, or didn't work very well. Right, options. Have any of you none of you traded options, have you? You all got a general idea of how they work? Yeah?
Very minimal generally.
Very minimal. Okie doke. That's fine. You don't need a vast amount of knowledge or understanding of options. I don't believe anyone trades options here, really. There may be some options trades put through occasionally. Generally, very outlier option type strategies, i.e. you buy really, really out of the money options on the basis that they might come in. A good example of that would have been, say, over Brexit. Rather than trade it per se, you'd buy very out of the money put options on cable and they should come into the money. That said, coming into Brexit, out of the money put options, I can't imagine were very cheap, because everyone would want to buy them just to cover that risk that it might happen. So we'll go and explain that in a little bit more detail. How about you, Peter? Have you traded options? If you're still there. The whole point of an option is it's a guaranteed risk for you. So whereas with futures, you can't guarantee the risk on it. Yeah, your futures position could start moving and moving and moving, and you perhaps can't get out of it. It can spiral quite easily with a futures contract. And if you're hedged against something, then that's fine, because what you're making in one thing, you're losing in the other. So you're hedged. Whereas with options, you get them effectively, it gives you the option to buy or the option to sell at a strike price. So you buy the option and you can then exercise the option if you want at the strike price, and then you get either the future or the underlying whatever the option is on at that strike price. Now, like I say, they can be on both the underlying and the futures. So that means you get this sort of double dynamic in markets where people will have options on the underlying stocks and options on the futures, and then they could use futures to hedge either of those as well. That's where it can start getting a little bit more complex. So whilst, say, for example, you might have options on an underlying stock, you could then hedge that option on an underlying stock with futures, or you could hedge it by owning the underlying stock. So quite a few different situations you can get there. Now, the buyer, and this is where I was saying about it limits your risk. For the buyer, there is no risk, or there is a risk, but you know what it is to start with. The risk is the amount you pay for the option. So you are out of pocket your maximum amount the moment you buy it. You're not going to be any worse off. Whereas the seller, or the writer of an option, they only get what you pay for it. They don't gain anything else. So their maximum profit is what they get as they write the option. They're not going to be any better off for it. However, they could end up a lot worse off, because of the fact that as the market moves, they still have the obligation to you. So if you have bought a call option, then you are expecting the market to rise. The call option will be for a certain price. As soon as it goes above that price, the writer of the option still has to give you the underlying asset at the price that you bought it, or at the strike price that you've agreed, meaning that their risk is unlimited. However, this is where a lot of the hedging comes in. As they go offside, they can then buy futures to cover it. So that's where you can start seeing a push through levels. That's where you can start seeing unwinding of positions, particularly going into the option rollovers, and when those strike prices actually come up and can expire. So we're going to talk about that in a second. Like I just said, call options give you the right to buy something. A put option gives you the right to sell it. And it is basically as simple as that. Like I say, the only strategies that I think anyone will really use here is to buy very out of the money options. So you're buying, say the price is trading at 150 and you buy a put option for 130. That would be a strategy of buying a very out of the money put option. The market's still got to drop from 150 below 130 for you to actually make any money. But theoretically, the price of this option should be very, very little money, because the fact it's so far away. Like I say, I don't imagine that would have been the case on Brexit, because of the amount of risk that was out there. People would have wanted to hedge that risk in some way, and a lot of the way to do that would be to buy put options as a way of hedging underlying risk, or as a way of having a punt on the election without really losing a great deal of money, so you could get in the trade beforehand. Does anyone know the difference between American and European options? Right. One of them, and I must admit I'm going to check my notes on this, because it'll be very annoying if I get it wrong. Right, there we go. I thought that was the way around. American options, you can exercise your option at any point. So you get your strike price, and say in that example, you're 150, your strike is 130, and you've got a 3-month option. So you've got 3 months to get below 130. If it does it in 3 days, you can exercise your option, sell 130s and buy them back. Maybe we're now trading at 125 because this has been an enormous move, and bank your $5. If it's a European option, however, you cannot exercise it. Excuse me. You cannot exercise it until the expiry date. So that's the main difference. which does create different trade dynamics when they can be exercised. European is at expiry, and I've got the answer there, and American at any time. Now, the majority of options are European. So what this means is that the majority of activity occurs around about the option expiry time. What is going on?
US Open.
Yeah, I guess so. Not much gone on. So S&P's got bought straight off the open. That's about it. Maybe that's it. Maybe that's all the excitement. But yeah, like I say, European ones only on expiry. I just read in my note here that basically everything on Eurex is a European option, apart from options on individual indices. So the cash indices, you can trade an American option on those on Eurex. CME, so the US markets are all European, apart from the S&P 500 options. The quarterly S&P 500 options are American, which is why you don't see a great deal of activity on US option expiry compared to European option expiry. European one, you see a lot of activity in the final few minutes of the option expiry because of the fact everyone's got to exercise that option. And so whilst the writers of the option can pre-hedge it, everyone who exercises the option gets their futures, gets their underlying, and now either is quite happy with them or they do something with it. And generally the reason you're going to exercise an option is because you're in the money. So we then get a little bit of activity on it, which I'll show you in a little example in a minute. In terms of option P&L, again, this unlikely to really be a major thing that you need to be looking into. But call option, basically this is assuming that you're buying the option on the left here. So call option, you buy it and immediately you're -6. Your strike price is 20.50, just here. Now you're still not in the money until you hit 20.56 because of the fact you've got to cover the premium of the option. As soon as you've done that, you are then in the money. The seller is now losing. This is what the seller's made. So they've made that $5 all the way up to 20.56 and well up to 20.50, and then they start losing, and then they lose indefinitely. You sell a call option and it's the same situation. So this is for the buyer up here and this is if you sell the option. So you're in the money for a while and then you're losing. You sell a put option, it's the same thing but it's the other way around. So with all of these kind of charts, if you do look up any sort of option P&L charts, remember this has nothing to do with time. It is only based on price. So you sell a put option, you're in the money until you hit the strike price, and then you're losing as soon as you drop through the strike price. Likewise, you buy a put option and you will buy it when we're at a quite high price. As the price is full, you then turn into the money and you start making money as prices continue to fall. Now, another strategy that, also another basic option strategy that people use is a straddle strategy. So the idea is you actually are basically doing this one and this one. So you're selling a call and a put, taking the premium out of both. And the reason that people do this, or the idea behind a straddle strategy, is that the market will not move out of a certain range. So as long as you range between the prices that you could sell, you'll sell puts here, you'll sell calls at this price. As long as the market stays within that, you never get exercised on them and you keep taking your premium. And so that can end up being a strategy whereby you then, when you see the break of the range, and this accentuates the break, all of these people selling those puts have now got to hedge. Theoretically, as long as they can still sell calls, then they're probably hedging the position to a degree. But they are still likely to have to hedge to a degree in futures as well. So that's one of the more basic option strategies. I'm probably not qualified enough to go into all sorts of different box strategies and strangles and all the rest of it, iron condors, and all the other silly names for option strategies there are out there. But the whole point from a trading point of view, from trading futures, is what it actually does to futures markets and how you create a movement and a tradable move based on what's happened in the options market. So, nice little example. We're going to look at, we'll call this 100. And we're going to look at, if you buy a call at 100, what happens exactly? So we're looking at someone who's a buyer of a call at 100. We're going to say this is what happens. And what you're essentially looking at is when the option would be cheap, when it wouldn't be. So we're going to say that this is the expiry date of the option. Now, if this is a European option, it cannot get exercised until we hit that expiry date. And so we've got a strike price of 100. So effectively, once you've covered the premium, so if our premium is $5, you need to get to 105, and then you are in the money. Now that's going to vary depending upon when you buy it, and it depends on a couple of things. One, time. Two, price. There's other different factors that go into it as well, but they're the two most basic and two probably most influential factors. There's also volatility factors that go into it as well. But essentially, the lower the price goes, the cheaper the call option is going to be, because of the fact that it's a lot further to go to get there. However, if you look here, we've got, assume these prices are both the same at 60. The option here is going to be cheaper than it will be here, or likely. Sorry, the option here will be more expensive than it will be here because of the time element, that you've still got perhaps a month and a half to get to expiry. In this example, you might only have a week and a half, and you've still got to do $40. So that's when your call options are going to be cheap. That's when your call options are what you would say are out of the money. So what then happens in terms of an actual trade is a couple of different things. This is assuming that there's only one person, or not one person in the market, but just the situation of this one trade. Now, there's going to be various other different trades, various other different ways of hedging it. But the seller of this call option, once we get up here, we're approaching expiry. What they could do is they could pre-hedge now. They could think, right, well, I'm likely to lose on this. I don't know how much I'm going to lose. But they then start to buy futures as the price goes higher to hedge their option exposure, which in a slight twist of irony, actually makes it more likely that their option's going to expire as a loss for them and they're going to have to pay out. But the idea is that they can buy futures to cover that loss. Alternatively, you will see a level get held and held and held and held, and that's where you could sell futures here and stop your options going into the money. So you could prevent having to pay out on the options and keep the premium. Now, if you've made 200 grand's worth of premium and it only costs you 100 grand to stop the futures going over that price, it's still worth doing. The risk is, of course, that you then end up very short futures and you can't get out, because whilst you can stop the price going above, don't know how that's happened, whilst you can stop the price going above, you've still got to get out of these positions, which will create buying, which could end up with you losing on these positions as they go higher. So there is a small risk there in terms of how you get out of positions. That was effectively a strategy that Nick Leeson employed in Rogue Trader, that he had a very large option position, and the idea was that he would prevent it going offside by buying Japanese stocks. But in the event of the, was it Osaka earthquake? Whichever one it was, Kobe. In the event of the Kobe earthquake, Japanese stocks got hammered and he couldn't buy enough to prevent them from going down. So what happened is not only did his options go offside, his futures positions did as well. And then he couldn't average his way out of futures by just buying more and hoping that it'd come back. In hindsight, and eventually it did. And this is always the case with these things, that it was his liquidity that caused the failing. It wasn't the fact that it didn't work. Which is where I do often wonder with a lot of rogue trading, how much do you actually hear about? Because the fact that you only hear when it goes wrong. There's probably a lot of people doing some very bad stuff out there, but as long as it doesn't bankrupt their firm, no one's ever going to know about it. But that was basically his strategy, to try and prevent the futures price going higher, or in his case lower. To do that, like I say, the other hedging strategy is to buy it through the price and hedge out your futures risk, or hedge out your options risk. Alternatively, you could buy call options as well, so they would match up against the futures. Now, the whole point of me explaining this bit is, how do you get a trade in this? Where's the actual trade? And the trade comes from the expiry. So when you get the expiry up here, it's all about what people do. Now, if you are the owner of these calls, you now all of a sudden can take delivery, and we're trading at maybe 120. What's the first thing you're going to do? You've now got, basically, you're long at 100, it's trading 120. The easy thing to you to do now is go, right, I'm going to bank this. You've paid your 5 premiums, so you've just banked yourself $15 on however many contracts you bought, which could be quite a significant win. And so what then happens is, you can often get selling either into the option expiry, as people preempt the fact that they're getting these fills. So rather than waiting to get them at 120, people go, right, if I sell futures now, I know I'm going to get the options at this price, i.e. 100. As long as you sell anywhere up there, you're still going to be banking a profit. And so the idea of selling it preemptively means that you're going to get better and better prices. And so that's partly where you get a lot of volatility in options expiries. You get not only the hedging, because the person who's been buying them to hedge his position now has a long position that he needs to get out of. You've also got the people who are taking the winner on the options that are then going to exit positions as well. But equally, you've then got the person who's been selling it all the way along here to try and prevent the price going up, now has a short position that they could go the other way and end up actually holding this drop by trying to get out of this position. Or alternatively, adding to this drop by trying to average the position out. So it's not as clear cut that you can come into options expiry and say to yourself, right, the market's going to do this or it's going to do this. But you know that because of the fact that people can't exercise the options before, there's going to be a lot more activity going on during those options expiries. And it is something that you're going to get two goes at. We got the February option expiry, because the options expire monthly, and then you've got the March options, futures, options on futures, massive rollover, where it all goes over at the same time, which can be more volatile, or historically more volatile. So,
say like a trader here, do you know what the expiry and the strike prices are on other people's
you
options?
can find out what the open interest is on those strike prices. So you can perhaps say, right, well, this strike price has got a greater number of contracts on it.
Yeah.
What you can't tell is how hedged they are.
Yeah.
Yeah, someone could have put on an enormous option position at one strike price, but that could be totally neutrally hedged out, and so they're not going to do anything. But I think you can make a rough assumption that, yeah, if you are near a strike with a lot of open interest on it, then there is likely to be a little bit more going on, because surely some of those positions aren't hedged and are going to create some kind of movement, or they're not even positions that, from the point of view that it's not that they're not hedged, it's the fact that a lot of the positions, the buying of the options could well be speculative buying, and so they won't be hedged, and they're waiting to see if they either make or lose, and then they will exit the positions there. So whilst I think it's quite useful to know, I don't think you can really create a strategy on it, because it could be that you just coming into one options expiry end up with a situation whereby someone is massively hedged the wrong way, or is trying very, very hard to push a position, or push either through an options strike price or hold it beyond back from one. Again, if you've bought a lot of call options and you're standing to lose the premium on them, it could be worth you trying to buy the futures to drive them all into the money. Even if you're not going to drive them far into the money, at least you're not losing your $5 premium on, say, 2,000 call options. So it might be that rather than losing 10 grand, you spend 5 grand on buying futures and try and push it through the strike. So there's another reason that you could get that drive through. But you do occasionally get it, and we'll do this, and I'll give you a few examples to have a go at trading when we do the replay week of options, when you see quite strong flows coming in. Unfortunately for you guys, the best examples have been in Euro stocks recently, which has still seen some pretty decent moves, but not the kind of thing that we've seen in the DAX a few years ago. DAX options recently have been very, very boring to trade, but there's always one every so often. I've seen one outlier, and I'll get a chart up for you one day, of DAX did 170 ticks on the option expiry. So 5 minutes, 170 ticks up and then back. So they do move occasionally. You do see some pretty crazy moves on the option expiry, and that, I think, was purely down to the fact that someone must have got caught one way or another, and it just drove the market in that direction. And because they've got to hedge, they will keep going until it gets to that price, or not to that price, until they've got their hedge done, because that's still more cost effective than taking the loss on the options. So yeah, you do occasionally see it. That was the thing with VW shares, which we'll talk about when we do equities later on this week. But yeah, effectively VW became the biggest company in the world, all because of an options trade. So we'll have a talk about that on Thursday. I think we'll do options, not options, equities. So yeah, we'll have a little chat about that. And yeah, see how VW went from a reasonable sized company to the biggest company in the world for a few days. Strange situation. Right, that I believe has wrapped it up for options, futures. Anyone got any questions? Anything unsure of? Everybody happy with trading futures? Excellent stuff. Tomorrow what we're going to do is we're going to do setting up your sims, getting you sort of ready, or getting you sort of used to it all, how it all works. Have you guys traded on TT before? Yeah? No. Okay, cool. So we'll get those set up. We'll go through sort of different order types, best types of orders to use or not. And then afternoon we'll do a bit on support and resistance, what makes it good, what makes it not, trend lines, basics, so you've got something to actually start trading off, something to start thinking about. And then we're just going to build that up slowly over the next couple of weeks in terms of chart patterns, indicators to use, all that kind of stuff. And then we'll move on to profile and a little bit more sort of advanced stuff. So that's the rest of this week. But yeah, we're going to go sort of mainly through the sort of fundamental side of bonds, equities, etc. But yeah, we do have Bank of England on Thursday, yeah, so might be a little bit more of a less structured morning on Thursday, and we'll spend a bit more time sort of looking at the Bank of England as opposed to perhaps doing the bond section, and then we'll just push that on to Friday. What I try and do is always give an option that if there is something coming out, we spend a bit more time looking at that and then shift the classroom stuff a day or a session back or forward so that it sort of works it all out a bit better. All good?
Yep.
Sweet.
Question about
Go for it.
the sim trading sessions
Yeah.
starting on Wednesday in the morning and in the afternoon. Is it going to be mostly drill driven, or is it going to be we prepare and we trade, or how is it going to be structured?
To start with, all I want you guys really doing is getting used to trading, trying to develop some of your own ideas, testing some of the things that we've sort of talked through. So trading trend lines, trading off support and resistance to start with. As we go into the later weeks, then yeah, there will be different drills. There's going to be various different tasks that we're going to go through, different sort of challenges or things that I want you to do. So we'll do a session on having to cut and reverse every trade, so you can never not be in a trade. You've always got to cut and reverse. Try to lose as much as you can. Trying to hold on to a position irrelevant of which way the market goes. Only taking a certain size winner, so sort of a scout-based drill whereby you can only take a free tick winner or a free tick loser. Various different things like that. So just to try and get you used to different sort of styles of trading. For example, to trying to hold a position, people find very, very difficult if it's not your thing. Because when it goes against you, you've got to decide either you're going to buy more or you're going to wait for it to come back. And the whole idea of it is I'll give you sort of a stop as well. Because if you don't have a stop, that's really easy. Goes against you, just buy more. Goes against you, just buy more and wait for it to come back. But if you have a stop, you've got to really think about where you're going to get in and get out of positions.
Money stop, right?
Yeah. Yeah, we'll do a couple of others in terms of where we got the replay up. We'll do a couple whereby I'll actually tell you where the market's going to go, So you'll know that it's going to go to a certain price, but you don't know how it's going to get there. So the aim there is around your ability to look at a chart and then enter the trade at the right price. So it might be that one of you will be in straight away, one of you will be in 20 minutes later, because looking at the chart they think that actually it should do something else first. Which again is quite an interesting one in terms of how people manage it, and then it's a case of how people manage how they get in, how they manage the size that they put into the trade as well. So that's the sort of challenge between you guys of almost who can make the most money out of it, despite the fact you all know exactly what's going to happen. It's rare that you'll all make the same amount of money. So yeah, we'll do a few different sort of challenges like that. Right, we'll wrap that up. It is 3 o'clock. Oh yeah, you guys don't have Sims anymore yet, do you? So up to you what you guys want to do. I'm still going to be hanging around here because I'm doing a debrief later. So I'll still be around. You're welcome to hang around. You're welcome to shoot off if you want. Up to you guys.
So tomorrow we are going to we get TT, right?
Yes.
And other software as well, or just TT?
It would just be TT tomorrow. And then we'll do the trading replay you'll get in week 4.
Right, but let's say like charting packages as well, or not really?
TT has charting package on it.
Oh, okay.
Yeah.
So profile as well.
Yes, it does have profile. Yeah.
Okay.
So yeah, we got all of that. So yeah, it's generally all TT based, which is all cloud based. Which yeah, TT is a good platform. TT is what, bar 2 guys, everyone uses TT.
For charts as well, or just
Predominantly for trading, they do use charts. I use TT charts as well as Investor RT. TT charts are very useful, particularly because TT charts work off the data that comes from the exchange. They generally won't miss out when, if a market gets busy, other charts that don't use direct from the exchange data run the risk of slowing down and lagging, whereas the TT charts don't. So that's where they're very useful. That's why I've always got some TT charts up. Excuse me. In terms of profile, I use Investor RT just because it's something I've always used. But yeah, we'll wrap up there for today, Paul.
See you.
Those online.